What if hundreds of thousands of dollars are being stolen from your future wealth right now without you even realizing it? There's a silent predator lurking in your investment portfolio, eroding your returns year after year. I'm talking about expense ratios. You work hard for your money. You diligently save, you choose your investments, and you watch them grow. But there's a hidden cost, often overlooked, that can erode your returns year after year, turning a comfortable retirement into something far less. Here's what most people miss. Most people focus on investment performance, like a fund returning 10% last year. But that headline number doesn't tell the whole story. What if that 10% gain came with a 1% annual fee? Suddenly your net gain is 9%. You might think, a measly 1%, what's the big deal? The big deal, my friends, is the power of compound interest, or more accurately, the power of compound loss. Over decades, even a fraction of a percent difference in fees can translate into a staggering amount of lost wealth. Today, we're going to pull back the curtain on this financial illusion and show you exactly how expense ratios eat your returns, comparing two identical investment journeys with one critical difference. The dilemma: fees versus returns. You have a financial goal: retirement, a house, college for your kids. You understand the basics of investing. Invest regularly, stay diversified, and let time do its work. But the world of mutual funds and exchange-traded funds, or ETFs, comes with its own hidden language, and expense ratio is one of the most critical terms you must understand. Simply put, an expense ratio is the annual fee all shareholders pay for a fund's operating expenses. This isn't a one-time charge. It's an ongoing percentage of your total investment, deducted from your returns before you ever see them. It's like a toll booth on the highway to wealth, and some tolls are outrageously expensive. Option A, the high-cost fund trap, the silent wealth killer. Let's dive into a real-world scenario. Meet Sarah. Sarah is 35 years old and decides to get serious about her retirement. She invests an initial $10,000 lump sum and commits to contributing $500 every single month. She's optimistic and expects an average annual return of 8% before fees, which is a reasonable historical market average. Sarah, like many, isn't fully aware of expense ratios. Her well-meaning financial advisor or her chosen online brokerage directs her to an actively managed mutual fund that has a good track record. This fund has an expense ratio of 0.75%. Less than 1%? That's barely anything, Sarah thinks. But let's crunch the numbers over 30 years. With an initial $10,000 and $500 monthly contributions, if the market indeed delivers 8% annually, but 0.75% is siphoned off each year, Sarah's net annual return is actually 7.25%. After 30 years, Sarah's investment would grow to approximately $748,000. Sounds pretty good, right? Almost $750,000. She made her contributions, she invested consistently, but she paid a significant price for that good track record and active management. That 0.75% might seem small, but it's 0.75% of her entire portfolio value every single year. Early in my own investing journey, I fell into this trap. I invested a chunk into a mutual fund with a solid track record. I completely ignored its 0.8% expense ratio. It was just a number. 5 years later, when I compared it to a low-cost alternative, the potential gains I'd lost due to those fees were sickening. It felt like unknowingly overpaying for a service when a much cheaper, equally competent option existed next door. That lesson cost me tens of thousands. Don't make the same mistake. Option B, the low-cost index fund advantage, the wealth multiplier. Now let's look at Sarah's twin sister, Emily. Emily also starts at 35, invests an initial $10,000, and contributes $500 monthly. She also expects an 8% average annual market return before fees. The only difference? Emily, being more financially savvy, chose a broad market index ETF with an incredibly low expense ratio. Let's say her chosen fund tracks the entire S&P 500 and has an expense ratio of just 0.55%. That's not a typo, 0.5%. This minuscule fee means that instead of a 0.75% drag on her returns, Emily only loses 0.05%. Her net annual return is effectively 7.95%. Remember, Sarah was at 7.25%. The difference is just 0.7 percentage points. Seems trivial, right? not over 30 years. After 30 years, with the exact same starting point, contributions, and market performance, Emily's investment would grow to approximately $900,000. Let that sink in. Sarah's portfolio, $748,000. Emily's portfolio, $900,000. That's a difference of over $152,000 for doing absolutely nothing different other than choosing a fund with a dramatically lower expense ratio. All because 0.7 percentage points, compounded over 30 years, added up to an entire luxury car or a significant down payment on a house. This isn't theoretical. This is how money works. These are real numbers, real investment opportunities lost or gained simply by being aware of and prioritizing low costs. And here's the crucial insight. The reason for this stark difference is simple. Actively managed funds like Sarah's charge higher fees for managers who try to beat the market. The problem? Most fail to consistently beat their benchmark after fees. Index funds like Emily's simply match the market by holding a basket of stocks mirroring an index. They don't have high-paid managers, so their costs are incredibly low. Historically, the market itself has been an incredible wealth builder. The verdict: prioritize low costs always. The evidence is clear and overwhelming. Expense ratios are one of the most significant factors in determining your long-term investment success. A high expense ratio is a silent killer of wealth, a constant drag that compounds over time, costing you hundreds of thousands of dollars. A low expense ratio is your best friend, allowing more of your hard-earned money to stay invested and grow. When you're comparing investment options, the expense ratio should be one of the very first things you look at, right after understanding what the fund actually invests in. Don't be swayed by past performance alone. Past performance is no guarantee of future results, but fees are a guaranteed reduction in your returns. The financial industry often complicates things to justify higher fees. Your job is to cut through that noise and focus on what truly matters for your bottom line. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making financial decisions. Your actionable takeaway today: 1. Check your current investments. Log into your brokerage account. For every mutual fund or ETF you own, find its expense ratio. It's usually listed in the fund's prospectus or summary, or easily found with a quick search of the fund's ticker symbol online. 2. Compare. If your expense ratios are consistently above your 0.20%, and especially if they're above 0.50%, it's time to seriously evaluate. Compare them to low-cost, broad market index funds or ETFs from providers like Vanguard, Fidelity, or Schwab, which often have expense ratios as low as 0.03% to 0.007%. 3. Consider a switch. If you find you're in high-cost funds, start researching low-cost alternatives that align with your investment goals. Moving your money to lower-cost options can dramatically improve your financial future. This isn't about chasing hot stocks. It's about being smart with the money you already have. Don't let hidden fees steal your financial future. Take control, understand your investments, and keep more of your money working for you. Now go check those expense ratios. Your future self will thank you.